Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks Associates Wealth Management. Today is Monday, May 1st, 2023, and this is our monthly market monologue where we will walk through some of the economic data that we see and discuss some of the challenges that we see as a result of this data. Obviously, we'll look at some of the stock and bond market action through the month of April. And at the end of the video, be sure to stay tuned till the end. At the end of the video, I will share a couple of snippets, a couple of video snapshots from some recent experiences that Braxton and I had as a result of participating in the CMT Association's 50th Anniversary Symposium. You won't want to miss that. And before we dive in, I do want to make another plug for our updated client portal on our website, hicks-associates.com. And once you click the client login button, there is a new link here to the HNA Wealth Management Client Portal. This is what we're discussing. A lot of our clients have been accessing their accounts by going to TD Ameritrade's website, advisorclient.com, and there's certainly nothing wrong with that. However, we really want to encourage everybody to get registered for the Hicks Associates Wealth Management Client Portal. If you have not yet gained access to that, feel free to reach out to me directly or to Karen Hyder at karen@hicks-associates.com, and we will get you registered for that site. Having said that, I also want to take a quick moment and encourage those of you who have the means to support me and our efforts to raise money to fight cancer. Once again, I have sponsored a cycling team for this year's V Foundation's Victory Ride to Cure Cancer. It will be a ride that we will do later this month. Many of us are going to do a 60-mile ride. Some will do a 30-mile ride, but we are all trying to raise funds for cancer researchers. 100% of the money that is raised from this ride goes directly to cancer researchers, and a lot of those researchers are right here in the Raleigh-Durham area. So if you have the financial means, we would certainly appreciate it if you would help us in our efforts. I myself am trying to raise $3,000 on top of the sponsorship that I've already provided the V Foundation. So if you would, I would be grateful. Also, real briefly, I do want to call attention to the investment policy statement that we are going to be rolling out over the coming weeks and months. If you have not already gotten a copy from your advisor, if you haven't talked about it with your advisor, please feel free to bring it up. But this is written in a manner that is designed to help you to understand a little bit more about the ins and outs, about how we are making decisions in our multi-strategy investment framework. That said, let's dive into the stock and bond markets for this month. So first up is the seasonality chart, which we look at frequently to show us the average performance for the S&P 500 since 1950, broken down by month. And if you take a look at the month of April, you can see a blue dot right above that bar, which is telling us that the month of April 2023 was just slightly better than average. Here we have the S&P 500 on a monthly candle chart. So every one of these candles represents a month. And what we really want to highlight is this level right in here. This is 4,100 on the S&P 500. And when we show it on a monthly candle chart, you can really see easily how important this level was. The market, yes, it came down and it started to rise, but we could never break through this 4,100 level until this month. Now, obviously, this candle we did break through, and you can even see we peaked through the level here in the month of March. So this is February. We'll show you that in just a second. But it wasn't until April that we were able to actually close above this level. And that's really important because that's showing us progress. Here we have, we could see the February 2nd high from earlier in the year. That is really the next level that we need to take out. And you can really see that here, the February 2nd high clearly got above this level, and this is where we closed, again, right around that 4,100. So a good last 2 days of the month for the S&P 500, but our next step is to take out this high from February 2nd. Moving on, we have the NASDAQ, and again, this is the monthly candle chart for the NASDAQ, and what we want to again look at here is this level. There's clearly a little bit of a resistance level right in here, and when we take a look at the daily candle chart, here's the daily chart. We'll zoom in just a little bit. Again, strong close to the month for the NASDAQ, but again, you can see this level that we need to break above. Now again, this week, as I'm recording this, today's Monday, the 1st of May, the Federal Reserve Board is going to be meeting on Tuesday and Wednesday. We expect their rate announcement on Wednesday. The futures market is really forecasting the fact that the Federal Reserve is going to raise rates one more time, and then they will likely pause. So what's going to be key this particular week is the language that Chairman Powell uses in his statement after their announcement about whether or not we're going to pause. So as we continue, now we want to look at the participation. We've looked at this multiple times. This is one of the ways that we're going to measure the breadth of the overall stock market's advance. In this particular case, we have the S&P 500 measured. This is SPX. And then we have three different breadth measures: the percent above the 20-day moving average. That's basically 1 month in the stock market. The percent above the 50-day moving average, or 2 months in the stock market. And then the 200-day moving average. What percent of the S&P 500 is above the 200-day moving average, which is about 9 months. And what I want to show you is that each one of these measures, we have more than 50% of the S&P 500 that are above these key levels. However, the problem with this is on the S&P 500. If we expand this, now we're looking at IWV. This is the Russell 3000. Same question. What percentage of them are above the 20-day, the 50-day, and the 200-day? The difference here is in the Russell 3000. This is capturing approximately 95% of the U.S. stock market, versus the S&P 500 is only capturing the large cap, in other words, the big names. This is going to capture the IWV, the Russell 3000, is really going to help us to take a look underneath the surface. What's happening with the smaller caps and the mid caps? And here we see a lot more weakness. Only about 39% of this measure is above the 200-day moving average. Remember, the 200-day moving average is that long-term indicator that if the index or the stock is above the 200-day moving average, that's considered to be in an uptrend. So when we go back and we look at the S&P 500, we can see 55% approximately of the S&P 500 is considered to be in an uptrend. And we see in itself the S&P 500 is above this black line, which is the 200-day moving average. But when we look at the Russell 3000, only about 39% of this broader measure of the stock market is indeed in a long-term uptrend. Now, one of the things you can see right here, this red line that I drew, this is at the end of the prior week. We're seeing some healthy improvement in the percent of the stocks in the Russell 3000 that are above the 2-month moving average. There was an early week correction last week, and we rallied back above that. So that's good, but we're still not at 50% on this measure. And again, not even on a 1-month basis. Now, the index itself is above the 200-day moving average, but there's still a fair amount of weakness underneath the surface. So what that's telling us is the large cap stocks are really pulling the overall market up. On a long-term basis, that is not healthy. So we have to be careful with that, and that has certainly been coloring how we've been investing for our clients this year. Is we're investing carefully because we're not seeing a broad participation in the overall stock market. It's only a handful of stocks that are participating. A lot of these indices that we're looking at, the S&P 500, the Russell 3000, they're cap weighted. And so when you see the S&P 500 is up a certain percent year to date, that's really impacted by a handful of stocks. And I think we're going to look at that in just a minute. Moving on, this is our advanced decline line. In this case, we're looking at the advanced decline line for the S&P 1500. So it's about half of that measure that we were just looking at. And again, the advanced decline line is showing us the number of stocks that are advancing minus the stocks that are declining. And here in February, this is where we were at the high. That we've looked at this high a couple of times. Well, the S&P 500, again, they hit that high back in February, and we're really close to that on the overall index, but you can see we don't have as many stocks right now that are advancing. So yes, the index is recovering, but not because the majority of stocks are advancing. It's only a handful. On the screen right now is the iShares Russell 2000 ETF, which is measuring the small cap universe. And for some crazy reason, I have my colors inverted here. The red line in this case is the 200-day moving average. And you can see that the small cap ETF has not been able to reclaim that very important level. We did see it happen earlier this year. Small caps started the year off well, but they really fizzled and collapsed back through this long-term indicator for whether or not we're in an uptrend or a downtrend. That happened in early March and really have not been able to reclaim the level. We can see some stability. It hasn't made really any new lows, so that's a good sign. But in order to have a healthy stock market advance, we really need to see the small cap stocks and the mid cap stocks participate. Switching gears to looking at the international space, on the screen now is what's referred to as a division spread chart. And all we're doing here, as you can see in the top right, we're taking SPY and we're dividing it by VEA. So SPY is the S&P 500 ETF, or one of the S&P 500 ETFs. And VEA is a Vanguard ETF. It is an international ETF. And when you do a division spread chart, the chart tends to point to that which is stronger. So you can see this long-term trend of going from the bottom left to the top right. That's the chart is pointing to the numerator. In this case, SPY, or the United States, is in the numerator. But what's happened here lately? Well, if we zoom in, this is the same chart. All I'm doing is zooming in. We can see that since October, the trend has definitely changed such that the international equities are beginning to show that they are stronger than the United States. Taking that a step further, this is the same division spread. All I'm doing is changing the denominator. So still the United States stock market on the top as measured by SPY. And then we're looking at Europe, or VGK, in the bottom, or in the denominator. And we can see that it was pointing to the United States, but since October, Europe has become stronger. So let's look at Europe. This is the European ETF that we were just discussing, VGK, the Vanguard Europe ETF. Now keep in mind, folks, none of these are recommendations. Obviously, if you're a client of ours, we're handling the allocation for you. If you're not a client of ours, we're not making recommendations. If you want to talk specifics about what we might consider for your portfolio, by all means, feel free to reach out to me and my team. We'd be happy to see if we can be of value to you. Again, this is my traditional color scheme where the black line is the 200-day moving average. And you can see that Europe had that same October low that we experienced in here in the United States, but it has recovered. And here we have the February 2nd highs, a little bit of a correction, just like we experienced, but the European ETF has gone on to move higher. So that is certainly a sign of strength. On the screen now is the Japanese Nikkei stock average. This is one of the most widely followed stock indexes for Japan. And I can't look at this chart without commenting that this is one of the reasons why a buy and hold approach may not always work out. Because this chart on the left-hand side, you can see it goes all the way back to 1990. Imagine being a Japanese investor investing in the Nikkei average and holding that for 30 or 40 years. Now, that said, look on the right-hand side of the chart, and we're going to zero in. You can see these red lines that I've drawn in. We're going to zero in on that. And here we are, just zoomed in a little bit. You can see this. There's this resistance level here that was support. So the Nikkei average broke through this level and it came back down a couple of times. It broke through it a couple of times. But this level has become fairly important for the Japanese Nikkei stock average. And you can see I've drawn this bottom upward sloping trend line. I'm going to zoom in one more time. And what I want to show you is that it is indeed breaking out again. So Japan is certainly a country that we are monitoring as we could very well see some outperformance. But again, not a recommendation. If you're a client of ours, we'll make those allocations for you. Here we have Mexico. Mexico on the screen right now dates back to 2019, and you can see that Mexico is also beginning to break out. This is long-term bonds, and what we're trying to show here, we probably showed this in last month's video as well, is that this is what we call a basing formation. Long-term bonds, this is part of the story of the Silicon Valley Bank, is they had a lot of their deposits were invested in long-term bonds, and long-term bonds are down like 30% in 2022. Well, and again, here's this October low, and the long-term bonds have recovered, and they're basing. They're up and down, oscillating up and down, staying within this basing formation. You can see that I've got an alert. That's that green dashed line set. That would indicate that it's breaking out from this base. So that is long-term bonds still in a basing formation. Once the Federal Reserve makes their announcement on Friday, we might very well see a movement out of this base. We'll see. Finally, just two or three more slides, and I'll show you that promised video from Braxton and I's trip to the CMT Association, which I think you'll find neat. This is inflation. Again, this is one of the things that the Federal Reserve has really been focusing on, as they're trying to bring down this inflation measure. And you can see that inflation is indeed coming down. This is giving us some degree of confidence that the futures market is correct, that the Federal Reserve will hike rates one more time this week, and then likely pause for some duration of time. Now, even if inflation comes down just a little bit more, it's still well above this longer term average of 3.4%. So inflation, even though it's not as high as it was, it's still expected to be higher than we are all used to experiencing. The other thing is, last week we got the numbers for the first quarter for GDP. And what we're going to look at here is first quarter GDP was 1.1. Now, in some of the videos I was showing you that the Atlanta Federal Reserve was forecasting GDP would be at 2% or more. That obviously, based upon the first reading of GDP, is not the case. GDP was at 1.1. And you can see this little red arrow that I've drawn. That is the downtrend in the economic growth. And that's really what the Federal Reserve is trying to do. They're trying to slow the economy and, again, break the back of inflation. So we'll wrap it up here for the month. Thank you for watching our monthly market monologue. We certainly hope you find these videos to be helpful. We will leave you with a couple of snapshots and brief video from when Braxton and I went up to New York City to participate in the CMT Association's 50th anniversary symposium. It was a fantastic conference with legends, legend after legend speaking, and it's just a great time. And we had a unique experience to have a cocktail hour on the floor of the New York Stock Exchange. So as somebody who's been in the business for 25 years now, that was certainly a cool experience.